In today's lecture, I'd like to talk about using the internal rate of return method when taxes are being considered. We've seen in previous talks that when we're using either the present worth or annual worth method with taxes, it's kind of a complicated procedure. And it's necessary to go through that procedure if you want to do an accurate calculation. But it turns out with internal rate of return, the procedure is very simple. We use a very simple formula, which I've shown here. The after-tax internal rate of return is equal to the before-tax internal rate of return times 1 minus the tax rate. The logic behind this formula is that the internal rate of return represents the percentage of the investment, which is net profit, is profit or net income. So since it's the profit that's taxed at the tax rate, the after-tax internal rate of return would simply be that before-tax internal rate of return times 1 minus the tax rate. Now this isn't precisely accurate because it doesn't take into account the fact that the depreciation is split over the first 2 years. But because it's such an easy formula and it's fairly close, it's a pretty good formula to use. Let's do an example here. Waterloo Industries pays 40% corporate income taxes. A project has a before-tax internal rate of return of 24%. Their after-tax MAR is 18% should the project be approved. Well, we have an after-tax MAR, but before-tax internal rate of return. We can use our formula to calculate the after-tax internal rate of return that should be used. So the after-tax is going to be equal to that before-tax internal rate of return of 24% times 1 minus the tax rate of 1 minus 0.4. And that works out to be 0.144 or 14.4%. So the after-tax internal rate of return is 14.4%. For before-tax internal rate of return, 24% when the taxes are 40%. So should the project be approved? Well, it is considerably above the 14.4% after-tax internal rate of return. So I'd say yes. But one has to keep into account the fact that this is approximation. So for example, if our after-tax MAR was 15%, and the internal rate of return was 14.4%, after-tax internal rate of return was 14.4%. Well, that's getting fairly close. And we might want to do a more accurate calculation to determine whether, in fact, the MAR does the internal rate of return does exceed the MAR. So it's an approximation, but it's fairly close and pretty good for most purposes. And this is one of the driving forces behind the use of internal rate of return method, because when you use it, taxes are kind of taken into account automatically in the setting of the MAR. Thank you.